Let's move on to the next topic. Before we proceed to analyze real price charts and see how we can identify inducement zones and how to utilize them in our trading plan, let's take a moment to understand the theory behind inducement from the point of view of smart money. This will help us establish a solid understanding of how price movement occurs in the market. To illustrate this concept, let's suppose we have a bullish structure like this that simulates price movement. As you can see, the price is currently in an uptrend. After a strong upward rally, the price experienced a retracement or pullback to the downside. This retracement is often seen as a temporary pause or consolidation in the overall bullish movement. As the selling pressure weakens and bullish momentum resumes, the price is likely to continue in its primary upward direction. In continuation, we see that the price made attempts to push higher, but failed to break the recent structure resistance. Instead, it formed an internal high followed by a minor pullback to the downside. However, with increasing bullish momentum, the price made a strong upward move, breaking the previous structure resistance and creating a new higher high. As a result, now have a break of structure to the upside and a demand zone associated with the break of structure, which has the potential to reverse the price. However, it is important to note that there is another nearby zone that has not been mitigated yet, creating a potential source of confusion for traders in determining which zone to trade. As we have discussed before, inducement areas are created by large financial institutions and smart money traders like central banks. They are designed to deceive retail traders into taking buy or sell positions in the market, ultimately creating more liquidity for them. So it's essential to be aware of these areas and understand their potential impact on the market. Indeed, this order block can be considered an inducement level. Market makers or large players artificially manipulated the price action to create a structure that would deceive traders into believing that the price was likely to reverse to the downside. As a result, many traders entered the market by opening sell positions expecting a bearish move. Their stop-loss orders were placed above the internal high, expecting the price to respect the structure and reverse lower. However, the market makers had different intentions, and the price eventually pushed to the upside, triggering the stop-losses of those short positions and providing liquidity for the market makers' buying activity. This manipulation resulted in a sharp upward movement. And also, this resulted in the formation of a fake demand zone and order block. It appears that the price was artificially manipulated to deceive traders and create more liquidity for large smart money traders, including central banks and major financial institutions. In the subsequent, we see that the price continues its downward movement and reaches the previously identified inducement zone. As expected, a small pullback to the upside occurs, driven by the buying pressure of traders who had entered the market with long positions from this zone. This pullback can create a sense of reassurance for other price action traders, leading them to enter the market with long positions as well. They place their stop-loss orders below the inducement zone, believing that it will hold as a significant support level. It is crucial to spot a liquidity sweep pattern that occurs before the price reaches our area of interest. This pattern indicates the absorption of liquidity and provides an opportunity to confirm the strength of the demand in our identified area. We use liquidity sweeps as a confluence factor before entering a position. The underlying theory is that the market requires liquidity to sustain its movement. If the price fails to sweep liquidity before reaching an area of interest, there is a high probability that the price will utilize that zone as liquidity to fuel its momentum. This collective trading activity creates a clearly defined liquidity zone located just below the inducement zone. This zone is characterized by the presence of traders who have placed their stop-loss orders within it. These stop-loss orders act as potential fuel for the market's momentum. Indeed, the price successfully swept the liquidity behind the inducement zone, confirming the anticipated confluence. Our next step is to monitor the price as it enters the higher time-frame demand zone. Once the price action is pulled into the higher time-frame order block, we shift our focus to the lower time frame. Within the higher time frame demand zone, we search for a change of character in the lower time frame. Additionally, we identify a new order block, in this case, a demand zone on the lower time frame. When these conditions align, we consider a long opportunity, with our target set at the external liquidity, which serves as the take-profit level. Now that we have a general understanding of how inducement zones can be utilized in our trading plan to enhance profitability, let's see the potential scenarios that may unfold when the price reaches the inducement zones.